Hi, everyone. We're just going to give it a minute here to allow last few people to join us, and then we'll kick off our session for today. We'll give it just a few more seconds, and then we'll get started. All right, I think we'll go ahead and kick off our session this afternoon. Welcome, everyone. This is Ann Gergen with AGRIP, and I'm happy that today we get to kick off a webinar on the investment outlook for public entity pools. We do have a great opportunity today to review the capital market performance from 2014, and also, perhaps more importantly, look ahead to the likely investment issues that public entity pools might face in 2015. We will do so with some really great examples in front of us from 21 public entity pools as a way to understand the very real results and comparisons that all of us might face. So I think you'll find real practical value in the information that's going to be shared in the next hour. With us today is Dan Smereck as our presenter. Dan is the Managing Director and Principal at Strategic Asset Alliance, where he has been since 2003. And prior to that, Dan worked within the malpractice insurance field. He's got a great breadth of investment, finance, IT, and similar executive experience. So just as we kick off the webinar this afternoon, all of the lines for participants are automatically muted. Dan will be able to take questions from all of you. There's a field on your GoToWebinar control panel that you can type any questions into. What we'll do as we get those questions is, to the extent they are particularly pertinent or timely to the slide that's being presented, we'll go ahead and give those to Dan as we go. Otherwise, we'll hold questions to the end. And I think with Dan's material, he has allowed for some time for questions at the end as well. So Dan, if you are ready, I will turn the control over to you, and you can get going.
Well, thank you, Ann, and good afternoon, everyone. On your screen is, for page one, the title page, and I'd like to just quickly give the outline of what I'm going to walk through today. And again, try to make this as practical and useful as possible. I know that you all get many talking heads and pick up newspapers and hear everybody pontificate about the capital markets. And so what we're trying to do today with the fact that we enjoy working with a number of pools is to share with you some direct information from the pools and a peer analysis, and then look back and look forward to some of those issues that Ann mentioned. So quickly, let's take a look at the fixed income market review, and let's look back really through when I finally put this presentation, the last touches on it, on the yield environment, looking back over the last year ending mid-October. October was quite a month in the markets, but generally what you see are these nice lines here on this page going from left to right, and they're color-coded on the bottom left to hopefully clearly identify is really the three major areas where insurers and pools are going to be investing their fixed income assets. It's generally you have the credit markets, which are corporate bonds or anything that is not a treasury that's going to be considered to have credit risk with it. We have in the middle of the page is the 10-year U.S. Treasury note. That's really the bellwether for yields in our economy and for the world. And then the green line here is the aggregate bond index, which is just showing, if you look at the entire investment-grade bond market where the majority of pooling assets are going to be invested, this is just a representation about what did yields do over the last year, because this is going to show us when new monies come in to be invested in any of our programs, what type of yields are we getting in the marketplace. The general answer is, looking at these numbers are low. And for those of you that can read those small numbers on the right, congratulations. But if we take a look at the top line, if you were just investing in credit instruments only, primarily corporate bonds, at the end of October, the yield on those on average in that marketplace was 2.81%. If you look at the 10-year Treasury, it was a tough time. It was at 2.18%. It's now up into the 230 to 240 range. And if you invested in a broad investment grade market, you're getting about 2.1 or 2.2. So if we think about what our fixed income portfolios are earning in the marketplace, that the answer is it's low. And it's not just you, it's everybody out there in fixed income. And the question is, how do we make the most of this environment with the tools that we have and what the market will give us? On page 4, just to give you a slightly different sample of just for those that like tables, is taking a look at really the markets broken down here. And I've highlighted with all these various information here is the red dotted box in the middle of the page that shows the yields at the end of September 30th, the most recent quarter end. And again, you can just take a quick look. The first top of that red box is just showing you the Treasury yields. And again, the 30-year Treasury yield is just a little bit over 3, but the 10 years at 250, again, back at 230 now. And then you look down below where it says, where there's a white gap, and then all the yields in these different sectors. And why, again, these are important is these are just showing you the other types of fixed income investments that where pools will invest their money, the broad market being the investment grade bond market or the fixed income environment. Again, if you were to buy the broad market today and go out and buy one of these passive fixed income bond funds, the yield on these instruments are in the low 2s. And so you can see as you move down, and some acronyms for you, MBS, mortgage-backed securities. Typically these are issued by the major agencies out there, the Freddie Mac or the Fannie Mae or the Ginnie Maes. Municipal bonds, again, in our jurisdictions, whether they're tax exempt or taxable. Corporate bonds, high yield, and you can see just the relative low yield environment. Then you hit high yield bonds and you see, ooh, there's a number that actually looks somewhat enticing, 6.13% yield. So there are yields out there. The real question is, are you comfortable with the risk that you would be taking in your pool in order to achieve those, assuming that your respective areas and jurisdictions will allow you to invest in things outside of treasuries, governments, and agencies. And I'll touch on that a little bit later. The other interesting thing, the second bullet point on page 4 down in the bottom here, over 80% of the world's bond markets have yields below 4%. And so when you think about that, and you look at how low our yields are, and if you look at Europe right now, some of the major yields, looking at the German bond in particular, their 10-year government equivalent to our Treasury is trading below 1%. So if you think about where money in Europe is going with the issues there, 2.5% looks pretty good in the U.S. as compared to what's available overseas. And the fact that we have 80% of the world's bond markets at below 4%, just to give you some perspective about how broad and deep the low yield environment is across the globe. On page 5, I like to include charts for a number of reasons. One is it just very quickly shows you how volatile certain things can be. And in this case, what you see on this chart going from left to right is really looking at the last 10 years is what's the, at each dot, at each point on any of these lines you look at is what was the total return for these respective benchmarks in the marketplace in fixed income. And so the easiest place to focus is in the very middle of the page is the high peak in the green line. And that was represented by the corporate bond market. So if we looked at the 12 months ending, really the end of December of 2009, in the last 12 months, the corporate bond market returned about 20%. And you think that 20% for corporate bonds, that was enormous. Well, if you look at the bottommost exhibit here, the sharpest drop on this page, that was what was happened in late 2008 and early into 2009, as we all know has been called the Great Recession. And of all the things that caught the market off guard in that period of time, it wasn't the fact that equities lost 40 to 50% of their value. It was the fact that the corporate bond market lost between 12 and 15% of its market value for a period of time until it came roaring back recovery-wise in the early part of 2009. It's that volatility here that's represented in this kind of looks like a heartbeat blip here in the middle of the page. It's just showing you how volatile the fixed income markets were during 2007 through 2009. They've calmed down a little bit, but I highlight this page here to show that these are really the three major areas, three major lines on where pools invest their money. The black line that's the most stable here between these is the broad U.S. market. And again, similar to the aggregate Barclays, this happens to be a Merrill Lynch indices. The reason I use this is that's what's available in this package I have. But you can see just how these returns track and how volatile things can be for certain securities. And so the issue is, again, if I'm investing in these, am I going to be compensated for the risk that I'm taking? On page 6, one major issue, particularly now it's interesting because our Congress with the Senate now transitioning over to having a Republican majority will be certainly put more scrutiny on the Fed, in our opinion. And why I included this slide here is just showing you who owns the treasuries that are outstanding. For all the debt that we've had to issue really since 2008 in support of, again, the Great Recession, with the Federal Reserve trying to stimulate the economy to the degree that it could, who's buying these things? Who's, as the government as the government issues treasuries, who's actually buying these? It's not just all of us. We certainly can't absorb that. So on the pie chart on the left is showing about 50% of the U.S. treasuries outstanding are owned by foreign countries, whether they're private or the central banks or other wealth funds in other countries. That hasn't changed a whole lot from 2 or 3 years ago, but I just put it out here. What is different is the Federal Reserve now has almost 20% of outstanding treasuries, and that's a function of the QE3, or the quantitative easing program they had in place, which just finished this past month. The reason I bring this up is the trend in the marketplace for the corporate bond market has been most private companies have been issuing corporate bonds to take advantage of low rates to extend their maturities to allow them more time and not have to worry about refinancing securities. Our government is a little different than that. The average maturity of the outstanding treasuries in the world is about 5 years. So every year you figure about 20% of this has to be refinanced. Well, that's fine as long as people want to buy these securities, which they have been. And the fact that yields are so low across the world, SAA views, we think this is going to continue on into 15 and into early 2016. But it is interesting to keep an eye on, because all the people who pound on the table regarding debt outstanding is we have to sell it somewhere, and who's buying it. And just to give you an idea, if there's upward pressure on rates, we have 2 areas. One is inflation, which we don't see right now. And secondly is who's buying our securities, and when they demand more yield, how is that going to affect the treasury market prospectively? For now, it's definitely an advantage to us. But I show this because this is what causes technical issues in the treasury market, supply and demand, and something we like to keep an eye on. Well, let's look at the other side of the equation. So we talked about fixed income, where we pretty much have to invest. We know that investing outside of cash generally is good because we all know what we're earning in cash, zero. Doesn't really matter where you put it right now. So the extent that you can move anything out and pick up a little bit of yield in fixed income is a positive. Now, this section here has to say, to the extent we're able and flexible enough with the net position or the surplus we have in our program, can we invest in other asset classes that have better, longer-term risk-reward profiles, meaning that we hope to earn a significant amount above and beyond what we would earn if we were just investing in bonds. So what we have on this page is just looking back over the last year saying, hey, did it pay to take risk last year? And so for these delightful colors on these bar charts here, if we'll go to the leftmost, which shows the return, and the black bar here to give you some relative perspective is what you would have made investing in just broad fixed income. And then you move to the right of that, and it starts to show assets that have more risk than the investment-grade bond market. And did you get paid for that? Well, the answer is yes, in every area here I highlighted just for today, except in owning commodities. And commodities have taken a hit primarily because of what's going on in China and the emerging markets. But generally speaking, you got paid to take additional risk. And where you got paid the most is in this bright yellow bar here, it just so happens, is in MLPs. For those of you who don't know what those are master limited partnerships. That's an investment structure. But primarily these are utility and infrastructure investments around the world typically that are going to support, oftentimes they're oil and drilling, but can also be with utility, power generation, et cetera, that have been very appealing really over the last 2 to 3 years. But I just highlight here, it pays to take risk. That's in the nominal sense. The next section you see on this page where it says Sharpe ratio, and this is a metric that was created by the Nobel laureate William Sharpe in 1960, back in the late 60s, to say, to come up with a metric, am I being compensated for the risk that I'm taking, given the volatility I know I'm going to assume? And so the answer here in this formula, which I won't bore you with that today, but generally speaking, anything that is above zero starts to say, well, I'm being paid for taking risk as opposed to just investing in the treasury market, investing in 90-day T-bills, or 1-year treasuries. And so all of these little bars here are above 0 and closer to 1. Unfortunately, the scales are a little off. When you have Sharpe ratios that are approaching 1, what that's telling us is that is hugely statistically significant that we are absolutely being rewarded for the additional risk we're taking as opposed to being investing in treasuries. The sole area here, of course, is commodities. So this is the real compelling reason when firms think about, organizations think about risk assets is, am I going to get paid for the risk that I'm taking? And then how do I consider that in the context that most of my investments are going to be in investment-grade fixed income? Another chart for you here to show you why we invest in fixed income primarily is highlighted with the black line and the blue line in the middle of this page. And again, another example of just showing you the annual returns at each point along the dot here, the last 12 months returns of the black line is the Barclays U.S. aggregate or the investment-grade bond universe. The dotted blue line is if you're just invested in intermediate government securities. And then the lines that have the most volatility are represented by the red line, which is the U.S. equity market. And then the green line is the high-yield corporate bond market, 2 asset classes that are typically explored when we look beyond investment-grade bonds. And you can see that those lines look a lot different than the 2 nice stable lines in the middle. And again, why I show this is that the investment-grade bond portfolio, historically, has provided incremental returns above what you'd earn just in cash and short-term treasuries. But when you consider investing in other asset classes, we just have to be wary, and we'll see this in a few slides, of if we're going to invest in things beyond that, we have to be comfortable that we can absorb the huge swings in returns and the volatility most recently that we saw in 08 and 09. And I'll tie that together. But just to show you, we have an anchor portfolio in core fixed. To the extent we have surplus levels that meet the needs of our programs, are there other options for taking investment risk as opposed to taking risk somewhere else? And again, I will come back to that. An interesting slide here, though, equities have been on quite a tear. And this slide here just shows, I pulled this interesting slide from the Economist 2 weeks ago. It's interesting, from the Great Recession of 2008, every time you listen to the radio or read the newspaper, it's earnings season. So earnings season just really passed us by here. And everybody talks about earnings per share for publicly traded companies. What did I earn per share is outstanding. Not many people talked about revenue, because you have to have revenue before you have earnings. And it was interesting that I noted in listening to the talking heads this year is more people in this last quarter focused on revenue per share. And this is this slide here is perhaps a reason why. If we look at where earnings have been since the stock market's recovered since 09, you can see earnings have been picking up at a nice little positive slope relative to the base year of the first quarter of 2008. However, if you look at revenue per share, it's pretty flat. So if we think about that, if our revenues are flat but our earnings per share are increasing, well, we're obviously eking out efficiency somewhere along the way internally in order to have higher earnings, or we're buying shares back with debt, et cetera. But really one thing I think telling is, for instance, the car industry. If we look at what the car industry was doing before this dot on this year, Q1 of 2008, they're building the same amount of cars now before 2008 with 35% fewer workers. And so when you think about that, that's how they've been able to squeak that out. The question is, how long can you do that if your revenue line is flat? And that has to do with aggregate demand and other things. There'll be another slide I'll address here. But just an interesting slide. And one of the reasons why is the second bullet point on this page is we've tended to be more focused towards stocks and dividends that have a little bit more yield orientation to them or dividend growth orientation to them. So not only are we picking up growth opportunities down the road, but we're also a little more focused on also earning a real nominal income that flows through our financial statements as opposed to just growth that you see in certain sectors such as mid-cap and small-cap equities. Well, I think the meat of this presentation, again, and we really appreciate the opportunity to share this with you, is we've been fortunate enough to be working with pools since 2004, and there isn't really a database that shows some of the investment comparisons for pools. And so we've been putting this together the last really 3 years or so since we had enough pooling clients. And so I wanted to be able to share this with you today so that you can also take this with you and see where your pool plots on some of these slides you're going to see. And just to cap what we have here, we have SAA has 15 pooling clients. We have 12 primary pools or first dollar pools, and we work with 3 reinsurers of pools. That represents, again, 25 portfolios. Why that number's higher is some of you have separate, distinct legal entities that are set up to ensure the various risks. Others are the commingled pools that just have the lines of business within one pot. It represents a little over about $2.6 billion in assets. It's split 85-15 between core and risk assets. And again, why that number is important is that goes back to the slides that show that volatility in a couple of those examples and how we're able to address that and think about that in context of being able to absorb that type of volatility in the investment program, but at the same time meeting all the needs and demands with all the liability programs that the pools offer to their members. So first and foremost, I will talk about risk assets, an allocation of this group subset, and that's on page 14. And most people are used to looking at this as, well, how much of my investments, and when I say risk assets, just definitionally, it's anything that is not investment-grade bonds. So anything that's going to be equities, high-yield bonds, anything that's going to be considered higher risk is just given the general term of risk assets. So in this sense, on this slide, I've just ranked our peer group hierarchically of the allocation they have to risk assets. And going from left to right, and these are all, again, pools, the highest risk asset allocation that we have is about 40% of the total portfolio. Again, total portfolio. And then as we move down and go from left to right, you'll see that slopes down. And then the red and green lines to give you some relative benchmarks. It's just showing you the average in red and the median allocation based on this group. For those that are all the way over to the right that don't have any allocation to risk assets, again, 2 happen to be health programs that just don't allow it in their investment policy. And the other 3 P&C portfolios there are not allowed by their state. They're governed, unfortunately, by the revenue, the municipality laws there, and can only invest in governments and agencies and mortgage-backed securities that are issued by the agencies. So that's why you see the blanks to the right. And so this gives kind of an interesting example here. We have a couple people on the higher end. But more importantly is on the next slide, which is page 15. Instead of looking at risk assets as a percentage of the total portfolio, we prefer to look at risk assets as a percentage of your program surplus. And I know that this is in your membership practices committee materials, and it's standard now under your financial management section that pools have written policies that include risk asset to surplus ratio as one of the many metrics that you would use to look at solvency. And we certainly have used this since our firm's inception because it gives you a better example of the risk that you're taking. And so when you transform it that way and you look and you see the ranking here, we have one pool client that has about 65% of their surplus invested in risk assets. But on average, it's down a lot lower than that. Typically, it's below 40, but generally it's in the 20. Right now, it happens to be just the way the math works out. It's about 22, 23%. But you can see generally we have a range of about, most of our clients are between 25 and 35% of their surplus is invested in risk assets. Again, only to the extent they have flexibility above and beyond what they're doing in their programs. So this is an important distinction, we think, on how we take a look. And again, the question would be, where does your pool, to the extent you're able to invest in other things, where might your pool sit on this graphic? On 16, it just
Dan, before you move off that slide, if you would, can you talk at all about whether you've seen any shifts among pools relative to this risk asset allocation over time? How does this compare to where pools might have been 10 years ago?
Sure. Well, I can speak to our client base on that. We had a number of our pooling clients when we started working with them that did not have risk assets. And as their pools surplus grew and their funding of their expected losses became stronger with that new surplus position over time, risk assets as a percentage of surplus has actually increased from what it was over the history that we've been working with our clients. So it's certainly an agenda topic when I just talk with pools that we don't work with around the country that do. I get asked that quite a bit. How would we invest in things other than fixed income? Where are your clients? So generally speaking, our clients, we've seen an uptick in risk assets, thinking much longer term than we were 3 to 5 years ago. On page 16, one of the things that people then ask, well, if you're invested, well, where are you invested? How are you invested when you're thinking about risk assets? And this chart, it takes a look at and says, well, where are we invested? And if you look just quickly and blink your eyes, you'd see a lot of blue in these bars. So these are 100% bars that take the risk asset allocation of the pools, and breaks them out as to where they're invested. And the legend's on the bottom, but most organizations, and probably the allocation that people are most comfortable with, because they're certainly used to it in their own portfolios, is talking about U.S. equities first and foremost. Of course, that's been a great place to be the last few years as opposed to the rest of the world. But generally speaking, most of the pools are going to be more heavily weighted towards U.S. equity allocations, particularly, and just to add on to Ann's previous question, when people first talk about getting into risk assets, U.S. equities are usually at the top of the heap because, again, they're most readily understandable, broad, deep market, and there's lots of ways to invest in the U.S. equities market. But as we look here and going from left to right, this is just showing the folks that have the highest allocation to risk assets are to the left, and then moving to the right to correspond to slide 15. And the folks who have the most allocation to risk assets are also one of the most diversified across risk assets. You can see on that column first all the way to the left, about 40% of their allocations to U.S. equities. They have a little bit of allocation to international equities. And then they have high yield bonds, and they have other, which happens to be global bond allocation. So part of this is just how long programs have been in place. That program's been in place a very long time with their diversified risk asset allocation, as opposed to a number of these pools on here are relatively new into this space. And so, again, there's no magic to this per se, and why these allocations will differ across the pools. It'll be a function really of the risk asset, the risk appetite of the committee, of the board, the actual risk appetite that the organization can handle. There's always an interesting interplay between what the financials say you could probably handle for investments outside of investment-grade bonds as opposed to how comfortable committee members and board members are. So that's always, I'd say, where we spend most of our time in how do we address that so everybody's comfortable with expectations when we move that. And that is the largest contributor to why these bars have different shapes and sizes as we look across from the different entities here. Well, let's look at core fixed income allocation across peers. And this being typically your largest allocation that all of you have in your portfolio, I just wanted to share with you, how our clients have been positioned. And this is as of June 30th. Since the majority of our clients have June fiscal year ends, I happen to choose that date to update this. But what you see on the vertical axis is book yield. And book yield is really defined as what's the earnings power of your fixed income portfolio. Not what the yield is on it now, but when you bought this security, what's the yield that's going to run off into your financial statements that you're ultimately going to report. And then on the bottom is the duration number. And the duration number is the most widely used measure of interest rate risk. And as a rule of thumb, duration is if interest rates go up 1 full percentage point or 100 basis points, then you can take duration and multiply it by that number. So if we see rates go the inverse of that number, so if rates go up 100 basis points, in this case, duration being 4 in the middle of the page where the 2 dotted lines are vertical, we're going to lose 4% of the market value of our portfolio. Now that's important. We're just going to lose market value. We're not going to lose money. We're going to lose market value because the new yields in the market are going to reprice bonds. The beautiful thing about bonds is when you don't have a need for them or have to liquidate bonds to fund operations and or claims, let's say, changes in price are largely ephemeral. And I'll show you a slide on that a little bit later. But what book yield is really showing us is what's the raw earnings power of these portfolies as of June 30th, really looking out over the next 12 months. Let's give a strong example. And so if you look at the general drift of these dots here on this page, you see they pretty much go from left to right, and they go up from bottom left to the upper right. And we'd expect that we'd have higher book yields as we'd increase the maturity in our portfolio. And what you see here is not a completely straight line because we have some things going on here. And if you look at, really, I just wanted to juxtapose the 2 yellow dots on the page that say the aggregate bond market yield to worst, if you were to go buy it, was about 2.25%. And it had a duration of about a little over 5.5 years. The intermediate aggregate was under 2% with a duration of a little over 4 years. Now, why include the intermediate? That includes about 90% of the investment-grade bond market. And so the difference between those 2 yellow dots shows you how much of 10% of the bond market is extremely long. So most folks are going to be invested in the pooling community, and our clients are more aligned with how the intermediate aggregate is positioned with respect to maturity or interest rate risk. And you can see where different people plot, and there are different reasons for that. I'll focus only on 1 dot on this page, is the highest dot on the page. has a duration of a little bit more than the average and the median, but it has a book yield that's about 3.75%. Well, this particular pool invests in a lot of spread product, a lot more corporates, commercial mortgage-backed securities, all high-quality securities, but they also were in the position as of when 2008 and 2009, when the market moved, were able to pick up advantageously a number of securities that are no longer yielding these high yields, and they're living on the past a little bit, but it's certainly helping them in greater context than some of these other folks. But I would focus you on book yield because that gives you what that raw earnings portfolio power is for your core fixed income investments. On the next page, it's saying, let's put a couple things together here and say, if I'm invested in risk assets, which is on the vertical axis, and I have fixed income duration, I have two key components that are going to add volatility to my surplus number. And one of them is how volatile risk assets will be, and the other is the longer my portfolio, the more volatile it's going to be with changes in interest rates. And this is just putting those two metrics on one page and dotting where that would be. And you can see most of our, so where you wouldn't necessarily want to be or where you're going to have the most volatility and to expect it is if you're in the top right of this exhibit. So to the extent you're at the top right of this exhibit, you would have the most investment risk volatility than perhaps some of the other folks on this list. And I'll just highlight, most of the folks are here in this about 20 to 25% invested in risk assets and have durations or fixed income targets that are intermediate in nature, again, driven by the types of liabilities that they have, but typically it's in the 4 to 5 year range. And I'll call your attention to the highest dot up there. Even though they have a high allocation to risk assets, they don't take as much duration risk as perhaps some of the other pools over to the right. So they're taking most of their investment risk exposure in risk assets as opposed to maturity risk in their fixed income portfolio. And again, with this plot, you're able to see perhaps where your program sits on this plot. Well, another term that we use is investment leverage. And this is another way to look at how our investment portfolio is affected by the investment program. And this is a formula that's it's a debt ratio really, but it's taking our invested assets of our program divided by the surplus or the net assets, and that gives us investment leverage because it incorporates also the reserves that are on the books that are being supported by investments, as well as the part of investments that's related entirely to surplus and not supporting reserves. And so when we look at it this way, we go to the far left here. And this metric is important in the sense that the higher investment leverage that you have means a couple of things. One, you have more reserves on your books, most likely relative to your surplus position. And as a result here, you can see the far most left this pool happens to be a reinsurer, is almost 450% invested assets to surplus. And all this really means is that, back to my comment about interest rate risk, their surplus in their portfolio is going to be more affected by changes in interest rates, just given how much more assets they have relative to surplus. And so we use this as another metric to complement the risk assets as a percentage of surplus, just to kind of see where we would be if rates move against us and risk assets have a tough go of it. Think of mid-October. What would that mean to our portfolio and how we monitor volatility and how we manage that? So another way to look at this, and most pools, as you can see, tend to be in that 100 to 200% range. The 400% is really an anomaly that's been slowly moving its way down. But generally speaking, between 100 and 200% is what we typically see in some of the larger client pools. On 22, again, different ways to look at different things for you all to see where you may plot here. And this is just taking a look at investment leverage on the vertical axis from the prior slide, and let's compare it to the percentage of risk assets to surplus to show. And again, the place you don't want to be, generally speaking, is way up to the top and to the right, is to have lots of your surplus in risk assets and have a high investment leverage. It's going to be great when things are good, but it's going to be not so good when things go the other way. So the question is, how do we mitigate that or understand our exposure? And again, just another way to plot on where you might fit on this scale as you're thinking about the investment program as it supports the liability offerings to your members. Well, how did everybody do? Great, Dan, you showed us these exhibits and all these different things. Well, how did these portfolios do, to give you another dimension to say, how did our portfolios perform relative to some of these? So again, these are through the end of June, and this is just the fixed income portfolio. And again, for relative comparison, I've included the intermediate, aggregate, and the aggregate bond index to give you some relative comparisons. And you can see where these portfolios perform. If we just draw a line here, people that had shorter duration tended to not have as much performance over the past year. Those that had longer benefited from declining rates over the past year, even though most of the major investment houses in the country didn't expect rates to fall this year. Well, they were all wrong, as most of the advisors were as well. The question is, were we comfortable with that? Were we positioned to handle that? And the answer is, well, yes. But as a result, we've seen these strong performance numbers for fixed income. And why you think about that, if you look at some of these folks who had 5 and 5.5% returns, it's interesting because the yield in the bond market's only 2.5%. So they earned another 2.5% in a price appreciation because how much yields fell over the year ending of June 30. For the 3 years, these numbers are going to start to be more important as you see trends in your asset allocation and how they generate returns longer period of time. And again, I think the important thing here is if you draw a line that connects the aggregate and the intermediate ag, is the majority of these portfolios have outperformed with lower duration the ag and the intermediate ag depending. And again, that's a function of the investment policies that they have. That most of these portfolios have broad, flexible investment policies that allow them to invest in sectors outside of government agencies and mortgages. And to the extent that's done properly and we don't have credit losses, historically that in any number of market cycles, that has been a positive contribution to longer-term returns, being able to invest in sectors outside of treasuries and agency mortgages within the investment grade bond area. Well, let's look at risk assets, how they do. Moving right along here is I put this slide a little different dimension. I've had to explain this slide a little bit more. So we have risk asset performances on the vertical axes, and on the horizontal I have the percentage of the risk asset portfolios of our client pools, how much of them were invested in totally in the United States. And why I included that is just to show the impact of diversification over the last year. So if you go and find the dots all the way over to the right side of the page that have about 25% returns, those folks were 100% invested in the U.S. equity market. So to the extent they had risk assets, they were invested in the U.S. equity markets. Anybody who diversified away from U.S. equities over the last year, they made money, but they didn't make as much money as if they were invested just in U.S. equities. And that's why you see the dots that trail off and to the left, down in between the yellow dots. I just put them at 50% just as a reference point to show how the S&P 500 did, how the EFA, which is the developed international markets, and how the Barclays high yield fixed income markets did. Really the three broadest areas when we move into risk assets. How do these portfolios do relative to those? The other important thing is to think about is when you have risk assets is how do they perform relative to your core fixed income? So if we look at core fixed income over the last 1 year, most of the folks were in the 4 or 5% range because of yield and price appreciation. But for every dollar you had in risk assets, you out-earned that by about 10 percentage points. So it's those types of issues. How much am I looking to earn above and beyond core fixed income when I migrate into these portfolios?
And Dan, just
yeah, you bet, Ann.
Clarification on that slide. So this is really performance for just the proportion of assets that were risk assets or invested in risk assets, right? So a 25% return for 100% risk investment, but that was only 40%, say, of the total portfolio, correct? That's
correct. And thank you for that clarification. And I'll tie all this in when I look at total performance, but wanted to highlight just how these little buckets have done across each of these folks just on a standalone basis.
And then also, are these returns that are net of fees?
Yes, these are net of fee returns.
Okay, thanks.
Thank you. On 3-year, again, here is again shows different trends here. Who's invested, who's not. And again, for those, the interesting thing here is that for those folks that were diversified more so than others, happen to not perform as well as the U.S. bond market, the U.S. equity market the last 3 years because it's been on such a strong performance trend. And I'll highlight your attention. There's one outlier here over here to the right that's below all 3 yellow dots. Over to the left. That happens to be a reinsurer that has a convertible bond exposure by design. And convertible bonds they capture some equity exposure, but they also look more like investment-grade bonds than some of the other instruments here. So that's looking back the last 3 years. That's why I always like to explain that. That's an outlier that has convertible bond exposure instead of U.S. equities. and why that return trend tends to be a little bit lower. But all of these fall in expectations. If I think about our other clients, these lines all look very similar. As people diversify, longer term, that's always been beneficial. But in this 1 and 3 year period, U.S. equities have ruled the kingdom, so to speak, in risk assets relative to the rest of the world. Well, if you put all this together then, and so building on Ann's question, how did these pools do in total? So this includes how the core fixed income and how the risk asset allocation, how all these perform together. And so what I did here to kind of highlight that is the total returns on the vertical axes, and the risk asset as a percentage of surplus is on the horizontal. And you can see, and then over on the left, you'll see a number of blue dots that don't have risk assets and just how they perform core fixed income. Most of them lower, one very high. And then you see the aggregate and the intermediate aggregate, just for perspective. Most folks who had core fixed income and an allocation of risk assets outperformed the core fixed income markets. And you can see as that trends up and to the right for the most recent year. The most recent 3 years, it also tends to be a trend. You see, generally speaking, most of these funds, either outperform, particularly the intermediate ag, which is where most of them are allocated to, but generally saw positive contributions to their investment programs by investing in risk assets over the last 1 and 3 year periods. And again, the question is to monitor that risk and monitor the expectations of the types of vehicles that we're investing in. Well, here's the fee. This is the slide that investment managers hate to see, folks, and so please take this with you. Of all the things here, one place you can get real money is to see where you are on the investment fee side of things. Now, we're certainly sensitive that there are lots of reasons why investment managers and various pools have broader and deeper relationships with banks, other local establishments, financial institutions, so we were very sensitive and appreciate that. But I did want to share with you this interesting trend. Investment manager fees, particularly fixed income, continue to surprise even me over the years on how these numbers continue to get compressed because yields continue to be low. And so the biggest takeaway from this slide is if you look on the horizontal axis, which is showing you the size of the fixed income portfolios in this sample, and in the vertical axis is the annual fees in percentage points. And if you look at really the 0.20 line across the page, so 20 basis points a year, 0.20% of your balances, there's not a lot of discrepancy or disparity between smaller portfolios and larger portfolios. Now, there are a couple of outliers on the top here. Actually, there are 3 dots up there that I've already had discussions about high fees there, and they've elected to stay there. But generally speaking, there's downward pressure on these. Example, I just recently finished a search for one of our client pools. To give you an idea, a $45 million pool, basis points get 12 basis points. So when you think about the incredible low rates out there and what certain managers may be charging, I always like to highlight this page because if your fees you're paying on this exhibit are north of my highest most number of 30 basis points, you probably have some latitude and some questions to perhaps ask your fixed income manager if you're above that line in our experience. On page 33, let's put this into even more perspective. If you take a look at what you're paying your investment managers based on the earnings yield of your portfolio, they really don't like this slide. And it's just to put things again into perspective when I've made the argument on why we should consider fee reductions for some of our clients, is you look at the thresholds are different now. And so what this is saying on the vertical axis, if I take your book yield and what the raw earnings power of your portfolio is for the next 12 months, and I divide it by the fees that I'm paying, this is just showing you how much of my yield is going to pay fees. And so the upmost dot here up to the left is saying we have one pool here, one of those I just mentioned, that's paying over 20% of their yield that they earn in their core fixed income portfolio to the investment manager. So it's not a critique, it just really highlights how low yields are, because if you look at these types of fees in this context, hedge funds charge 2% and 20% of profits. And if you look at this, we're charging, in this context, no one's really charging below 5% of your book yield for what they're giving you. So I just offer this in context to provide yet another way when you talk to folks, if that's appropriate, is to say, what are we really getting for our fees in this low yield environment? And everybody's under this pressure. I just had dinner last night with an investment manager, and of course they all gripe about lower fees, but it's really the nature of the game, and certainly a very easy way to get money back into your program if your fees are above market. With a few more slides left here, some of the things I'd like to leave you with here is what's going on in the investment opportunities here. And I divide this page into two sections. The section on the left between the dark bar in the middle is showing you what's topics that have been addressed with those pools that have highly constrained investing. Those that are under the various municipal laws only of their states that can only invest in really cash, treasury, bonds and notes, agency bonds, et cetera. The considerations here below that, you have things to think about. Do you extend duration to maybe pick up a little more yield longer term but still have volatility in your financial statements? We've been able to add agency MBS. Some places are language saying you can't invest in mortgages, but they contradict and say you can invest in agency-issued securities. Well, the government sponsors the three big mortgage providers, so we've been able to insert that in a couple of client programs. Subordinated agency debt sounds just like it's labeled there. The agencies, like for instance, the Freddie Mac or Fannie Mae or any government entity that issues their own straight bonds or debt, but it's subordinated to some of the other securities they offer. That's a way to pick up some yield. Brokered CD programs. These are programs where you stay within the FDIC insured CD limits, and you go out and buy basically fully insured CDs and have a broker that goes around to banks all around the country. My only concern with this in the past has been is sometimes the fees are hidden as to what you may be paying for those types of programs, given how low CD rates are. And I just offer that from my own observations with those. We don't have any clients that do those, but I know of a couple pools out there that I've talked to that do. For the folks who have more flexible investing, I have on the right page again for you for a takeaway is all the highly constrained items we can invest in, of course, but also investment-grade bonds, mortgage bonds, asset-backed bonds. Asset-backed bonds, the irony here is mortgage-backed bonds are asset-backed bonds. They're backed by mortgages. The mortgage market was started first in 1983, and the asset-backed market really came afterwards. So asset-backs typically are credit card receivables, auto loan receivables. Those are the two biggies, and frankly, anything else they could pack into that, but those are the two biggest ones. High-yield bonds or junk bonds, and then equities. Considerations down here, and I have two colored fonts just to kind of highlight some of the topics that I've been having with our pool clients. Not necessarily some action, but a lot of discussion. Increased non-treasury allocation. That we have done consistently. I'd say that's a philosophy of most organizations. If you can move out of treasuries and do so prudently, you're going to pick up more risk-adjusted yield long-term, real surplus addition with the yield from those allocations. Duration extension. It's kind of hard to extend duration these days and pick up a lot of yield without picking up a lot of volatility. But again, it depends on the program you have and how much surplus you have and what you're trying to accomplish. The various blue lines here, I won't go through each one, but just various topics that have been discussed across our pooling clients about where we can perhaps consider diversifying and investing for longer-term, higher return expectations as opposed to core fixed income. The biggest one here is going to be the strategic asset allocation changes. Getting this allocation right is the largest decision that any pool can make, is to how comfortable I am with this allocation away from investment-grade bonds and into other things, because this is what's going to drive your returns and expectation of returns in the future, more so than any of the little selection or fund selection criteria you may make in between those times. Alternatives, that can be a four-letter word. It just depends on who you're talking to and what that means. But really, alternatives these days have been, you've heard hedge funds, you got real estate deals, you have direct commercial real estate. There's all kinds of interesting asset classes out there. And the only thing I'll mention about alternatives is a lot of the investment management shops out there are working very hard to bring these asset classes to smaller organizations in order to allow them to typically invest in a fund format, much like a mutual fund, but allows exposure to that. And that's certainly something that innovated over the years as they brought the initial investment values down considerably in some of those asset classes. So is all I'll say about that. So let's look ahead quickly with the time I have remaining here. Is the world economic issues on page 36. We have slowing China growth. First of all, you believe the numbers coming out of China. That's always an issue that's coming out of China. It's definitely a managed economy that way. It's certainly growing slower than it ever has, but it's enormous, and their middle class has grown leaps and bounds. That's something to keep in mind because as their demand slows, the demand for commodities, that's one of the big drivers on why the commodity markets certainly have gotten hit this year, and that affects the emerging market production machine that's out there. So that's something obviously the world is keeping an eye on, and they have their own internal issues, having 6-7 times the population of the United States that they have to administer in that country. We have falling oil prices. Brent crude, intermediate Texas sweet crude, they both hit 3-year lows. The Saudi Arabian government just lowered the price again on what they're charging the U.S. for this. The way it's going, the U.S. is going to be importing less than 25% of its oil here in the next couple of years and actually exporting more with the shale boom. So that creates an interesting twist for the Middle East oil countries, and just generally there's been slowing demand for oil with the slowdown in Europe and the emerging market in China. It's interesting because as those, the counter argument to that has been, as I've heard, and I tend to believe this camp, is that certainly it makes alternative energy investing not nearly as economical. So the question will be how that will continue to keep up if oil prices stay low longer. Ebola, that was in the newspaper. It's all over for a while. It's calmed down quite a bit, it appears, to the extent you believe that it's been certainly contained from what it was, but that certainly had people scared with the whole pandemic and with people on airplanes. None of this is really a surprise, but it was hard to believe. I think most people were surprised it happened in the U.S., that we actually had this outbreak. But that's, again, something that's certainly in the back of people's minds, as that's still not completely contained, but it's been improved. The real issue, in our opinion, that is going to govern really the broader investment issues for pools and insurers globally is the inflation expectations. And this is the issue of the Fed targets a certain level of inflation really since the Reagan years, is to keep that in check. But if we look here, I'm looking back since 2012, and we look at the 5-year forward rates for inflation in the financial markets of what they're telling us. And if you look at these, you can see Britain, the U.S., but really the U.S. and the Eurozone, they're all sloping downward. And so we don't really have any inflation expectation. And my favorite metric is when they break out headline inflation or core inflation. And of course, core inflation doesn't include food or energy. Well, I don't know about you all, but we all eat and we drive cars. So if those are inflating, we know we have some inflation, but it's really been outpaced by the tremendous dampened pressure in the economy, which is kind of represented on this slide, 37. This is taking a look at most of the developed countries in the world and looking at their inflation target ranges, which are illustrated by the blue dashes and the white lines for the gaps. And then if you look at where the headline inflation and core, the CPI, are in place, you can see almost all of them are underneath. The majority of them, particularly the bigger zones, are all underneath or at the lower end of their targets. You have Brazil, which is off the scale, and then Russia has its own issues with the sanctions. It's kind of hard to put any meaning into that. But generally speaking, we're below inflation targets and trends. And really the other issue is the output gap, which is over on the right, represented in those white boxes. And the output gap is a metric that says if it's negative, that we're actually producing, the economy is producing less than it's capable of producing. And if it were positive, it would be say it's producing really more above and beyond what it's capable of producing, really only for a short period of time. Well, what this means, if we're operating at one of many metrics people look at, but if we use this solely as an example, and you look at the U.S., for instance, with an output gap of minus 3.5% between what the economy could produce and what it's actually producing, there's not a lot of inflationary pressure with that type of number. And you can see in most of the developed world, that's the same thing, at least as of the end of September 2014. So thinking about inflationary pressure in the U.S. and what that might do to rates, that's really not going to have much impact, in our view, into 2015, early 2016. The Fed may elect to raise rates on the shorter end of the yield curve, but it's really not going to have that much of an impact on the longer yield curve. It's these types of things in the perceptions of the world economy that's going to drive those, not, frankly, what the Fed does, again, in our view. So with that on page, another huge issue for you all to think about, if your managers haven't talked to you about this, it's bond market liquidity. The world is a different place, and this is a great slide to highlight that. If you look at 2007 in the middle of the page, you see outstanding corporate bonds in blue, and you see dealers' inventory in red, and far beyond that. So they had about $2 billion, they had about $8.5 billion of inventory. Why that number is important in 2007 is that if one of your investment managers is buying and selling a corporate bond, oftentimes they would sell it to one of the big investment banks on the street that would then take the bond and put it in their inventory and then use that to basically help them keep market liquidity. Well, let's look what happened in '08 and '09 and today. Those red bars are all now below $4 billion. So the liquidity of the bond market is very different from what it was pre-2007. And why that is so important is that now when you call up your manager, and if you have a crisis situation, you need cash, and it's in corporate bonds, if you need something ASAP, the odds of you getting not a very good price, depending on the issue, are much greater now than they were pre-2007. So in thinking about when liquidations need to occur for securities that are not traded as often, in this case corporate bonds, but it could be asset backs or others, it's not something to scare anyone. It's something to be mindful of when we think about cash management and then how that dovetails into using investment managers to help provide needed liquidity when it's needed, but giving them ample time to execute and get the best prices possible based on market conditions, because that stopgap is no longer what it was. 39. This is an important slide. You lose your mind looking at it, though, but it's making a point on stability of returns. And this is looking back since 1990, so really the last 15 years. And I've shown you here on the red line in the middle of the page and the green line. The red line is the income return of the 10-year U.S. Treasury, and the green line is the return of the corporate index, the Merrill Lynch corporate index. And the one key takeaway here is you see investing in corporate bonds over that period of time, you made more income returns at any point in time than investing just in treasuries. And this goes back to my comment about to the extent you're able to diversify and move away from treasuries and still maintain your operational liquidity needs, that is a very compelling reason to do so, because you're making this incremental return nominally as well as risk adjusted. Then you have the bouncy lines between the blue and black lines here, and that shows the price return. And so this is showing the volatility depending on what point in time where interest rates move. So even though you have this volatility in pricing in your bond portfolio, look at the middle of that page and you see that nice steady income stream that's being generated by bonds, because on next page 40, depending on what period of time you look at, yield is the largest contributor to your returns in your fixed income portfolio. And as an example up on top, I have the 80s, the 90s, and 2000s, and showing that between 90 and 97%, depends on what study. Going back 50 years, it's about 95% of your total return that's generated by your fixed income portfolio is due to yield. So back to my point, to the extent, excuse me, that you can manage yield prudently and pick up incremental returns by investing in other asset classes besides Treasury and agencies, has paid off in a significant way over much longer periods of time. This is my personal favorite. This is the what keeps you and me up at night slide. And putting it in context, I've not yet found a client or an organization that is disappointed when talking about positive returns when things are very volatile, as long as they're making money. And that is always a nice thing. But what this slide is saying, well, we know we're going to have periods of time when we're going to be losing money, at least temporarily, and are we able to handle that? And so this slide here takes into consideration looking only at downside returns, on how ugly did it get depending on what asset class you were invested in. And this looks at the most recent 15 years, ending August 2014. And it just shows, it includes the dot-com bubble, if you go from left to right, and it includes, of course, the Great Recession in 2007, 2008. But I want to call your attention to the fat black line in the middle that rolls across the top and barely moves down. At its worst, it was down 4.5 or 5% and came back up. That is the aggregate bond market. That is the investment-grade bond market, which is really the anchor of any portfolio. And even in the toughest times, you can see we had some downtrends as yields may have widened in corporate bonds or other securities outside of treasuries and agencies. But generally speaking, it's been consistent. Back to that previous slide, that 95% or so of your total return in fixed income is yield. So if you have that as a basis, the question is, are you comfortable then tolerating these other jagged asset classes that sit below? And for this, I won't torture you with those, but you can see all these asset classes that have significant downside dips. A lot of times they're temporary, but they will impact your reported financial surplus. And so we include this slide to say, when we talk to folks out there, to say, hey, risk assets are great, but we have to be mindful that we're going to have periods of time where we're going to see downtrends like this, and we have to be comfortable that we can absorb that over time. Well, we see the volatility in the markets, but we know over time we're going to pick up more incremental return than we are if we just invested in bonds. And so that highlights there, where is your pool's comfort level, and that can vary significantly from pool to pool. Some key boardroom themes, just 2 more slides to end with here. Some of the key themes just from last year to share with you across our pooling clients. And there's always lots of things discussed in committee, but these are some of the things that really jumped out. Investment policy, compliance, and flexibility. It's a key document to have because it's really the guidepost for your investment manager and your investment partners is to understand, and it articulates how comfortable your pool's board and risk investment committee or finance committee is with investments. And so to the extent they will use that to program into their systems to make sure that they're in compliance with those limitations. Roles and responsibilities, understanding who does what and why, and more importantly, when there's a violation of a policy, which happens not actively typically, but passively because of market changes or a security downgrade, what's the process so that we have that resolved? What's the communication process? I already mentioned changing bond markets, the liquidity, a big issue. Educated a lot of folks on that this year, investment managers as well. It's just a different world out there and how difficult it is because bonds do not trade on an exchange like stocks or exchange-traded funds. If I want to buy 100 shares of IBM, I can go to any broker anywhere, and I'm going to get the same execution no matter where I am because of the exchange. Bonds are different. You may go out and buy a bond, that same IBM, let's use IBM, great corporate bond, highly liquid, but you may get 10 different prices from 10 different dealers when you want to go and buy and sell that bond. So it just makes things a little more difficult. And as long as we understand that, that just helps in the cash management process. The second bullet point, strategic asset allocation. Really can't stress that enough. This is one of many examples I've seen, but generally speaking, in the analyses, the academic studies are out there. It's typically between 90 and 95% of your investment performance is going to be governed by your strategic asset allocation. And then the rest is in the selection, other factors, market time, the little things. But really, it's just strategic allocation, which goes back to that. What percentage of my pool, to the extent I can, do I have investments outside of investment-grade bonds? How do we deal with low yields? I already talked about that. You can only work with what the market gives you. The biggest thing I've had to say this last year is, well, Mr. Smereck, can you go get us more yield? Absolutely, I can get you as much yield as you'd like, but you may not like what happens when markets get a little volatile. So it's always in context. The managers are very creative. Wall Street's very creative. To the extent you want yield, you can get it. It's just I don't necessarily think you like what the volatility profile would be if things go against you. Investment risk management and communication. In my tenure here, interesting thing about managers, very infrequently do managers get terminated for performance reasons. It's typically because they botch communication and client servicing issues and keeping people informed, open communication, changes in process, what's going on. A very key issue there when working with any investment manager. And lastly, the quest for prudent yield is what I would say. And this just kind of recaps some of the things that were high on people's list and things that we did in the last year for those. We increased non-treasury allocation in investment-grade bonds. In some cases, we extended duration a little bit to allow investment managers a little more flexibility for folks. Taking on some additional credit risk. Corporates, high-yield corporates and bank loans, those have all been very hot sectors. We've been in them for quite some time. Bank loans are interesting because they're classified as high-yield securities, but they have very little interest rate risk exposure. It's really a credit instrument, and that's been very interesting because it's been complementary to other asset classes. So I want to take credit risk, but I don't want to take maturity risk, and that's been complementary to some portfolios. World debt, again, the rest of the world is a huge issuer of debt, so if there are opportunities, why not consider taking that to the extent it's allowed in regulations, restrictions. REITs, real estate investment trusts, they've been on a tear the last year or so. Again, another diversifier. REITs are designed that they have to pay out at least 90% of their earnings, otherwise they lose their tax-exempt status, their tax preference status. Those have been a tremendous source of yield for folks, but again, they're as volatile as the real estate market in the U.S. and will rise and fall with the sentiments of that marketplace. High dividend equity is a big place where we've been participating for years, and that is to take a look at equities, but see about defensive, large cap, well-known equity out there, the S&P 500 types, that have yields that are higher than perhaps what we're earning in our core fixed income portfolio. And so in those situations, we can trade out and say we can leave our investment income flat, not change our investment income, but also then pick up the higher return expectations of being in equities. Alternatives, I've already talked about those. Just recap again, a lot more different diversified types of asset classes that were unavailable to smaller, mid-sized organizations are now coming online, which creates some other interesting opportunities to the extent you can get through the transparency in the education process. But lastly, on 5 points I would like to leave you with that we've always found myself kind of hard saying some of these, but coming from an insurance background, before working with SAA is, before you think about your investment portfolio, one of the things is we've advocated is, underwriting improvement via risk management initiatives. So to the extent when we look at how we would consider investing additional assets, in some instances when we've done this, we've included, well, are there risk management initiatives that you've all shared with us? What do you expect those to earn back for you in the form of improved loss ratios, et cetera? And to the extent that those have a better profile, why would I invest in risk assets if I have something internally like this that I'm going to get more bang for the buck on my loss management or mitigation as opposed to risk assets? Investment fee management reductions, already talked about those. Strategic asset allocations, big one. So these are some of the things here at the end I'd just like to leave you with. But we always like to think of the investments as holistically and secondary to everything that we're trying to accomplish. So in that sense, whatever we're trying to do on the liability front, how does the investment program support that? To the extent we have additional capacity to take investment risk, what's prudent, and can we do that thinking longer term? And then how do we layer that in when thinking about what other initiatives you're all trying to do, and how does that translate into return, not in the investment sense per se, but in return to the organization? To my last comment about risk management initiatives, how do we factor all that in to make a program that supports the surplus position that then ultimately supports all the liability programs and initiatives that each of your pools may have? And so with that, you've undoubtedly heard enough of me, and I would turn it back to Anna. I'd be delighted to answer any questions or address any concerns you may have, but most importantly, thank you very much for the opportunity to spend some time with you all today.
Dan, and you really did a good job of wrapping it up there. The investment strategies are so critical to pools in terms of pricing and member retention. So it's really great to have the perspective that you've brought across multiple pools. Thank you so much for your time and for being a resource to us today. You did a good job of answering questions as we went along, and I'm mindful of the time here as well. As we close down, just 2 quick comments. One, Dan mentioned early on in his presentation that there is this risk asset allocation as a percent of pool surplus, the way to be looking at the risk asset allocation. That is an update that we've made through our AGRIP recognition standards recently. So for those of you who are participants in the recognition program or are looking at that program, go back and take a look at that, namely that pools frame their understanding of risk allocation in this way as a percent of their total surplus. So please do take a look at that. The other thing as we close here today is just to note that we are not doing an online survey of this webinar, but if you participated and have comments or questions or things you'd like to follow up on, by all means, just shoot us an email and we will get back to you or be happy to take any input that you have. So with that, thanks again to Dan, and thanks everyone for participating.